Welcome, everyone. This is Catherine Tyndall in the Financial Advisors Want to Know show. Today, we're going to be talking about equity sharing and compensation issues for running practices. I have with me today Carolyn Armitage. She started her career as an advisor. She possesses firsthand knowledge and deep empathy for the challenges advisors face. With the CFP and CIMA designations, she's held roles as a consultant to CEOs of wealth management firms, the head of wealth management for several firms, and an investment banker. Collectively, her years in the industry have positioned her to learn and share valuable insights with advisors in the field, and she has her own consultancy firm where she's actively working with advisors for a lot of these niche issues that they can encounter running their practices. So welcome to the show. Thanks for joining me today, Carolyn.
Thank you, Catherine. I'm delighted to be here.
So in a little bit of the pre-show, we were talking about how for running these advisory practices, talent acquisition and retention is a core problem of the business, and dealing with how to structure your compensation, and in more particular, how to structure your equity relationships with some of these, high-powered talent that you hopefully can attract and bring in, is a huge issue. And so, as you've been working with advisors and your experience in the field with this over the years, for people who are facing this as kind of you get over the hump of figuring out your client acquisition, and then it really turns into a talent acquisition game. How do you help? Where's the place to start for people to approach these issues, and how they should be framing how they're structuring things for, kind of that second phase in the business?
Yeah, thank you. So normally clients will come to me when they're at some type of turning point. Oftentimes it is after they have had turnover in a key person at their organization, and they don't want that to happen again. And they realize, I need to do something. Sometimes they're lucky enough that the employee comes to them first and says, I should be paid more, or I want equity. A lot of times that employee just leaves quietly on their own, and it's too late after the fact. So I like to think of compensation as one of the components that helps you attract and retain employees. It's by no means the only factor. If it was, it would make a very shallow relationship. And if someone came to you solely for the compensation, guarantee you they will leave you for somebody else's compensation that's higher. So really, when you look at a compensation plan, yes, the monetary part is the most objective. And in my world, my side of the consulting, it's the easier part because there is a right number. There's a midpoint and there's a range for every position out there in the industry based on the size of firm that you are, where you are located, and your business model. What gets more thick, if you will, is the culture of your organization. Mm-hmm. So employees not only want fair compensation, they want to feel appreciated. They want a fair workload. So many people want flexibility nowadays. And I know many CEOs are not comfortable with work from home. If you are, that will help you attract other folks. And it does present opportunities. It also presents challenges. So you have to be prepared to manage through all of that. Employees love peer recognition. That's super important to them, to feel valued at the organization. They want to feel empowered, that they have the opportunity to have a voice in the organization, that they're heard. They want to have learning opportunities so that they're moving forward, both personally and professionally. Mm-hmm. And all of this makes for a very complicated approach to your human capital. And yet it's a service business that we're in, and it is oftentimes the largest expenditure on your income statement. So it is absolutely paramount that you get this right.
Yeah. And it's always something where, I joke because I'm in the accounting world, and when you're in professional services, your biggest assets and biggest drivers are things that don't actually show up on your financial statements, right? Like the loyalty that employees have to an organization, the vision that the organization has, those are all things that we can't really quantify. You get that downstream effect of what's going on in the financials from it. But when you're in these kinds of situations, it's really hard to quantify if you're doing everything right. And some of what you were saying was really reminding me of the statement that, when you're building your practice, your dream has to be big enough that other people's dreams can live inside of it.
Right.
And if you're not accounting for what your people's dreams are and building something that can accommodate that, it then turns into, like you were saying, if they're just coming in for the compensation, they're going to leave on the compensation because you haven't built a future for them in the bigger vision of what you're trying to do. Mm-hmm. So a big question that I think comes around this too is sometimes people think, oh, well, I just need to give people equity, and that's the answer to this. Mm. I've heard differing opinions on that. So I'd love to hear what your thoughts are on, oh, well, maybe if I just give them equity, then they'll stick around, and how you feel about that.
Yeah, that's a fabulous question. And it's one that there isn't one right answer. So blanket statement, it definitely isn't appropriate to give everybody equity and or the same type of equity in most cases. And what I mean by that, so let me back up for a second. So I have been an employee at numerous organizations where I'm running a wealth management firm, and I have been a recipient of a variety of equity sharing programs, as well as short-term incentive compensation programs, as well as I put these in place for advisors. And I have been with clients where I sit down with the employees as part of an overall human capital review, and sometimes the employees will complain that they were given all this equity, yet they can't cash it out right now. They don't have that money right now. It's in the future, and they're having a difficult time paying their bills, and they'd rather have a much smaller cash bonus today than the play of a long-term equity incentive plan. And of course, to me, that was heartbreaking, right? Because the CEO was very generous, or it was a six-figure equity sharing allocation to this employee, but they wouldn't be able to touch it until the firm sold, which would be like 10 years out. And and so it was really a miss, right? When somebody is overly generous and it's not appreciated, it's not really
Yeah.
the intent. So,
Mm.
and also with equity, it is or lack thereof, lack of sharing equity with a kind of heir apparent is the number one reason why that heir apparent will leave you,
Hmm.
right? That owner, maybe they're a founder of their business, they have promised for years that this person, this, next
Yeah.
generation advisor is supposed to be their successor, yet nothing is in writing. There's no equity
Yep.
sharing. They don't believe it's ever going to happen. They get frustrated and they leave. Whether they start their own organization or they move to another firm, sometimes taking clients with them because they can, and move to another organization that will provide that equity. Um, So it's super important for financial advisors, and the better, like higher producing financial advisor, more sophisticated financial advisor, they absolutely get it. And so one popular strategy that's been in place kind of for about the last decade is phantom plans,
Hmm.
because sometimes owners will say they don't want to give up real equity. And so some other consultant helped them, oh, put in place a phantom plan, or they read somewhere to use a phantom plan. And a phantom plan doesn't oftentimes meet the intended consequences. And sometimes it'll actually be the reverse, right? So you would consider sharing equity when you want someone to act like they're an owner and step up their game and help you with your business strategy and implementing and managing some of the people and some of the um, aspects of running the business, right?
Yeah.
And in a phantom plan, the participants know it's not real equity. They sometimes feel really hurt that it's not real equity. And so they actually kind of pull back at work.
Mm.
And then certainly for anyone who's tax conscious, and the smarter financial advisors and employees are, phantom plans, when your units vest and you cash out, you are taxed at ordinary income, not capital gains rates. So it's kind of that double slap that it's not real equity, you're not really an equity owner, and it's really a cash bonus program, right?
Yeah.
So
Yep.
call a spade a spade. Is it a deferred comp plan? Is it a rolling bonus program? Is it a phantom plan? They're all cash plans.
Yeah.
That can be a real cash drain on the organization and not the intended consequence of having that employee stay with you for the long term. As soon as those shares vest, they will be cashing them out. In almost all cases, that's normally what I see. So there's also restricted stock units. Those have the same effect, where folks will cash those out as soon as they're able to. And needing to keep monies in reserve and pay out that cash can really drain the organization. And this only compounds the bigger your organization is. So I'm a fan of offering real equity. There's a variety of ways that you can do it, both in a static form as well as a dynamic form. Um, it depends on the type of business or entity that you have as to what plans are available for you. And then you may actually implement a couple of different plans, one for your administrative or operational folks, and then another one or separate one for your advisors. And this is often done in larger organizations where the higher end executives have a different benefit plan that includes these higher level equity sharing plans than what other employees have access to. And so you really need to right size the plan for the intent you look to achieve and the level of employees that will be participating.
And when do you think, I guess at like different breaks in size where you've seen it make sense to get more nuanced in the planning, or when people are actually approaching this on a tactical point, it's like, okay, is this something that I need to be thinking about when I bring in my, you start off with different admin staff, maybe you get a couple of junior people in, and then it's really for maybe like, when do you need to start thinking about this around, once you start going for some higher quality talent hires, like when does this process begin of making some of these decisions around how you're going to structure things, and when does it make sense to readdress it too, in terms of what you've seen from different organizational sizes, or where they are in their life cycle of growth?
Yeah, that's a great question, Catherine. So typically this will be as the practice morphs into a business, right? So they're evolving, they're getting more sophisticated, they're bringing on more people. Now all of a sudden they have a business. And what I mean by that is there's more than one partner or senior advisor, or they're recruiting in another advisor with their book of business, where when you bring on that advisor, of course, advisors have a couple of affiliation options. One is the independent contractor model, and the other would be a partner model. The independent contractor model makes it less risk for the business because they're not taking on a full partner.
Yeah.
Yet it's also a transient business, right? You see articles on so-and-so moves from one firm to another all the time. It makes for very competitive payouts. So your profit margin on independent contractor advisors is much smaller than if you had a partner model. And this does come back around to equity. I'm not just going down a rabbit hole
Yeah.
unintentionally. So with a partner model, if somebody has a book of business, they can come to you, and let's say you each have 200 million in assets under management. Combined, you have 400 million in assets under management. As you put your income statements together, there may be some synergies. And together, that collective $400 million in assets is valued more than your individual $200 million books of business. And so the pie actually gets bigger. So you could bring that advisor on as a partner, and you each own 50-50 of the business if they're that identical, or maybe it's 60-40 or something like that. So that now all of a sudden you have a real equity partner in the business that will help you grow it from there on after. And I've done that with numerous organizations, and it works out to be a very successful long-term model where you can actually scale the business well. And that's one of those instances where real equity makes a dramatic difference versus simply having an affiliation model where it's a 1099 relationship. And every single day you have to prove your worth, and that, every single day that advisor may leave you, and they have the right to.
Yeah. No, that's great. And bells are ringing in my head for like, we should make this a future episode soon of just discussing partner arrangements and, the process of bringing somebody on, because that is such a huge topic on its own. But I think that is really a great segue from, if you want to bring in high quality talent in an equity position, maybe you really, instead of trying to just have somebody at that employee level, look for people where they are coming in as partnership material just to start with. And looking at it a little differently that way. But yeah, well, this was, as we wrap things up, this was a great, short conversation around the equity and compensation issues. Where can people connect with you, Carolyn?
Yeah, thank you, Catherine. It's been a pleasure to be here today. So I have a website, carolynarmitageconsulting.com. Of course, you're welcome to look me up on LinkedIn as well, Carolyn Armitage, and I'll be happy to connect with you and talk about your situation and how you can attract and retain the best employees and scale your business.
Wonderful. So thank you for joining me, and thank you everyone who's listening. We hope you enjoyed this episode of Financial Advisors Want to Know. If you want to connect more with us online, I'm very active on LinkedIn myself, and in the show notes, there'll be a link to our website and the tax work that we do for advisors. Thanks.